Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. If you're looking for dividend stocks and you're looking in the oil patch, there's a good chance that ExxonMobil is on your radar. This is a company that's increased its dividend every year for decades and has shown us that it can print cash in the current environment. I'm Jason Hall. This is The Smattering. I'm here with Tyler Crow, and we're going to talk about another oil major that is gushing even more cash than ExxonMobil if you adjust it down to a one-to-one basis. And that company is one that you may not even know anything about. Hey, Tyler.
It gets even weirder because the company that I'm talking about actually changed their name. The company I'm talking about here is Equinor. It used to be called Statoil, the Norwegian oil and gas giant. They're about 65% owned by Norway. And so it's one of those ones that flies a lot under the radar because it's owned so much by the state, only really operates in Norway. And so I'm guessing a lot of investors probably aren't spending a lot of time looking at the Norwegian continental shelf when it comes to oil and gas. But I'm here to tell you that you probably should.
Absolutely. And for a couple of reasons I think are important is, number one, as much as Norway, a number of the Scandinavian countries have prioritized renewable energy, particularly for their domestic consumption, the reality is that Equinor specifically, and more generally, all of those offshore oil and gas reserves are a massive part of the country's economy.
Yeah, and not just Norway's, but also Europe in general. One of the companies that really stepped up to supply Europe was Equinor. And some of the plans that they have been mentioning as of late was really ramping up their natural gas production and supply so that they can ease the supply chain issues that they've had with natural gas in Europe. And it's a very profitable venture for them. And what's even more promising about them is that we were just mentioning the Norwegian continental shelf. That's actually one of the cheapest places in the world to produce oil. I understand that, it's a harsh environment. Typically, it's cold weather climate, but the oil that Equinor produced, I was about to say Statoil. That's how long I've been looking at
Old habits
die hard. But their production costs are less than $30 a barrel. It's some of the cheapest oil in the world. It's accessible. They know where it is. They know how to get it. It's just basically
the infrastructure is already in place to get it to market, and that's important, particularly with offshore oil. And you get to these deep water, more harsh environments when the infrastructure is already in place. That substantially improves the profitability for these kinds of resources. I want to pivot a little bit and talk about ExxonMobil. I think you could look at Chevron or certainly the American super majors. We've seen their dividend yields have come down substantially as their prices have gone up because they've demonstrated this extreme profitability, and investor interest has grown. And that's, to a certain extent, the same for Equinor. Its dividend yield has come down. Now, my question for you is, thinking about future yield, thinking about future dividend growth, and the valuation of these stocks, make the case for Equinor versus, again, using ExxonMobil as the proxy here.
Sure. Now, obviously, with a lower dividend yield at Equinor, it's a little bit of a slightly tougher sell, right? Why would I buy a lower yield? Let's talk about what's actually backing that yield. And that's where it gets really interesting for Equinor. Let's give this a little bit of a grain of salt because 2022 was a fantastic year for oil production. Probably 2023 is not going to be as strong. But in 2022, ExxonMobil had a free cash flow yield of 13.3%, meaning basically free cash flow per share divided by its share price, it's 13.3%. For Equinor, it was 30%, more than double. It's because the higher natural gas prices in Europe, much more exposure to that sort of thing, as well as the low costs that we were talking about. This company has been throwing off free cash flow at absurd rates as of late, so much so that they've completely transformed their balance sheet. They went from having debt and a lot of the other, like the oil majors, good balance sheets is like, 10% debt to capital. This company now has $20 billion in excess cash, just more cash than total debt sitting on the books. So even though it's a considerably smaller company, if you start to back out cash, it becomes an extremely small company. And the management team has been negotiating with the Norwegian government to buy back shares. And that's kind of been the big value add for this company as of late, because they're not planning on expanding capital spending, don't want to commit to big dividend increases. So we're just going to buy back stock like crazy. And that's been a huge uplift for per share value of this company in the past couple of years. I understand some people are apprehensive. You heard a lot of things about like European windfall tax credit or windfall taxes on oil and gas, but a lot of that hasn't really happened yet. And there's even starting to see some pushback. And at the same time, tax rates in Norway are already so high. And yet, despite the high tax rates, this is still happening. And so with all of
That's
that
important.
considered,
The free cash flow yield. This is free cash flow. This is after everybody that gets money has gotten their money. Is very
this much extra cash left over.
The last thing I want to mention real quick is valuation. And again, I think this is important. Equinor trades at about 5 times expected earnings for the next fiscal year, and it's a little closer to 10 times for ExxonMobil. From a valuation perspective, how do you think about Equinor right now?
Even at a forward P of 5, I think there's some baked in a little bit of optimism in oil prices, which if I want to be conservative, I would say we could still see lower oil and gas prices from here, which I don't know if I necessarily believe that, but if I'm making an investment, let's just say that's the case.
If you're investing in an oil company or natural gas company, always assume prices will fall lower than your threshold.
Yeah. So even baking that in, like I said, production costs are less than $30 a barrel for them. So there's a huge cushion of where things could go from the downside. And even with that and all of this excess cash on the books, it seems to me that the company can still do a lot to add value to shareholders, even if we were in a much lower oil price environment for quite some time.